there are problems with fixed rate debt. And this is the thing that people don't really understand. Fixed rate debt means that, if you have a 5-year hold and you get a 10-year loan and you're trying to sell in year 5, you're going to have enormous prepayment penalties. But the main advantage of these bridge loans, even though they have variable rates in there, after 12 months, you could sell for a point.
Hey everybody, welcome to another episode of The Remote Investor. I'm Michael Album, and today I'm joined by an author, educator, syndicator, investor, Michael Blanc. And he's going to be talking to us about all of the things we need to be aware of if we are going to be thinking about raising capital to go fund some pretty big deals. So let's get into it. Michael Blanc, man, thanks so much for taking the time to come hang out with me today. I really appreciate it.
That's great. Looking forward to it.
No, I think this is going to be a ton of fun. I know a little bit about your background, but for those of our listeners who aren't familiar with you, give us the quick and dirty. Who you are, where you come from, what is it you're doing in real estate today?
Yeah, I grew up maybe like so many listeners and watchers here. I was taught to get good grades and get a good job, and that's what I did. And I actually got a master's in computer science, Michael. I'm highly educated, and which I then duly threw away. But anyway, in the early days, I was actually a programmer. Spent some time in AOL in the mid-'90s, and in 97, I joined a software startup called Web Methods that was out of Northern Virginia. And 3 years later, the company went public. Yeah, I was in the right place in the right time. I was one of the early employees. So it put a bunch of money in my pocket, which was cool. And then I read Rich Dad, Poor Dad in 2004, and it threw me for a loop because I just thought I was a pretty smart guy. And I realized that I wasn't so smart. And so I realized that, it's not about how much money you had with, whatever your brokerage account or in your thing, which I had quite a bit at the time, but it was about the passive income. And I went back and forth on this for like 2 or 3 months and finally quit my job to pursue financial freedom, to parlay this money, this IPO money into actual passive income. And so I kind of I just did all kinds of seminars to study how money works. I flipped a couple houses. I traded stocks and options for a couple years. I took a commercial real estate boot camp. But the big idea was restaurants, obviously. I mean, that's probably what you would do. And
the obvious choice.
So I bought a franchise. I bought a pizza franchise, and it went well for a couple of years. It was fantastic. We're buying and building stores. I hired a guy to run the whole thing. It was set up. It was perfect. Until the recession hit. And then things were not so perfect. Revenue declined rapidly and never recovered. It actually just was a downward spiral. And I realized I had to fire the guy. Now I'm running 6 restaurants. And I realized I had to sell these things. And they were losing money. They were losing like $10,000, $15,000, $20,000 per month. And I'm literally running out of cash. And I figured I got to do something for income. So I decided to flip houses. I tried to flip my way out of it. So I started borrowing money from hard money lenders. We're buying 2 houses a month. Then I started borrowing money from private individuals. And so that thing was starting to make money while I'm trying to extricate myself from the restaurants, which took literally like 3 years to get out of. So I'm trying to get out of these restaurants, running the restaurants, flipping houses, making money. At the end of the day, I'm working 80 hours a week and not making any money at all. So it was the most stressful, unsatisfying part of my life until in 2011, I accidentally got into an apartment building. One of my wholesalers brought me an apartment building. It was a 12-unit in DC, and it was a nightmare for the first 18 months as well. And then finally quieted down and started sending me $1,500 a month in mailbox money. And that's when this very delayed light bulb went off in my brain going, wait a minute, maybe I should do more of that and less of this very exciting flipping stuff. And that's kind of when I started to pivot. And in 2014, started blogging about it on Bigger Pockets, my own website. Started a podcast and wrote the book in 2018, and then kind of built a bit of an educational platform as I'm doing deals today with Nighthawk. We own about $300 million of real estate. And on the educational side, the mission really is financial freedom. If you really want to be financially free with real estate, there's really only one way to do it, and that's apartments. And if you do that route, you can literally quit your job within a year. So it's very exciting to be able to do that.
Man, there is so much good stuff there. I feel like you've lived like 7 lives and you're still quite a young person. So this is awesome, man. I'm just curious, what about franchises and the restaurant industry, turning back the clock here, made you say, yes, this is for me. This is how I get passive income.
So many people do that, especially people with money. And I had money, and I was like, man, I get myself in passive income. And I talked to other franchisees, the Five Guys Burgers, which you may be familiar with. They're actually from Northern Virginia. So, I hung out with some of these Five Guys Burgers franchisees. They're like, oh, dude, you got to hire a guy. You just got to fund it all. And then you just got to sit back and count the passive income. I'm like, Boom! That's exactly what Robert Kiyosaki talks about.
Yeah.
That's why I did it. What I didn't do is I didn't actually really talk to someone who's got experience. Like these were all very new franchisees. Five Guys Burgers at the time was like literally printing money. They're no longer printing money, is my understanding. In fact, a lot of them are going out of business. So I haven't really talked to a seasoned restaurant guy. Thankfully, I met this guy in the depths of my sorrows, and he kind of walked me off the ledge. And I'm still in touch with him. I met him from Thanksgiving as well. Really great guy. I just wish I would have talked to someone like that before I got into it. I think a lot of people get into a franchise thinking that this is like this fantastic passive income vehicle, and it's not. It's really a job with serious risks and serious consequences because you're signing leases, personally guaranteeing leases. What can possibly go wrong? I mean, the numbers they can be very profitable, but at the same time, they can also be very negative. And I just didn't realize the fact that if you don't really love restaurants, like you don't love food and you don't love people, like, and you don't like, and you're not prepared to be in there like all the time, this is not the business for you.
Yeah.
And there are a lot of people who are very successful with franchises, but they're much more hands-on. There's a bit of a passion for them. And for me, it wasn't. It was set up as a passive investment. Now, real estate the same way. I mean, no one really wakes up and goes, "Oh, I can't wait to do some more real estate." Okay, that's not the case either. I think real estate is simply set up more to be a little bit more on autopilot. A lot of things can still go wrong. You still need to have people in place. But for me, like franchises, restaurants, you gotta love the business.
Hey everybody, I wanted to give a quick shout out to myfiacademy.com. That's MYFI, short for My Financial Independence Academy.com. If you're looking to get started in real estate investing or looking to scale your portfolio up from where it currently is and are looking to take the next step, come check us out. We've got on-demand content with everything you need and everything that I wish I had when I first got started investing. From one-on-one coaching to at-yourself-paced content, it's worth checking out. That's myfiacademy.com. I look forward to seeing you in there. Yeah. Well, I think too, like to your point, you've got to love it. But with real estate versus franchises, like most people have lived in an apartment or a house. And so we inherently understand, okay, it's made up of walls and this, if something breaks, this is how you repair it versus a restaurant.
Much simpler.
Totally,
house,
totally.
Tenants, some repairs.
Right. Move on.
I mean, a franchise, you got to understand marketing, sales, finances, how to handle cash, employees. Oh my gosh, turnover is wild. Then you got massive repairs. I mean, the complexity, just the idea that you can do this like passively until you get to a certain scale. It's a little bit like house rentals. Like you got to achieve a significant scale before it becomes a little more passive. And I was getting to that, but the path there, oh my gosh,
sounds brutal.
It was very brutal. Yeah.
How did those other guys that you chatted with back in the day that were like, this is the best, you got to do it, how did they fare during the recession?
I don't know how they fared, but I lost all of my restaurants, and I don't think to this day there's a single restaurant left on the East Coast or anywhere else where it didn't originate, this particular concept, which shall remain nameless. I was the biggest franchisee. Yay me. And so when I went out, there was no one left on the East Coast. It was awful. Yeah.
Dang. All right. Well, so then you picked yourself up by your bootstraps. You flipped your way out of the restaurant and landed into this apartment building. So talk to us a little bit about like why was that deal so rough for 18 months? Is that the norm? And then we'll take it from there.
Yeah. So number one, before I get into this, what I realized about flipping houses was it's a lot of work. It's slightly less work than owning a franchise. I give it that, but there's still a lot of work because if you're not buying, fixing, and selling houses, you're not making money. And then once you sell it, obviously the money stops flowing. And so I didn't like that about that. And so I did think of building a rental portfolio, but you need a lot of rentals to really make. If you imagine $10,000 per month in passive income, you need like 30 to 50 houses. Okay. And that's a lot of complexity. So this apartment building, once it quieted down, really made a lot of sense to me. Now, why was it such a nightmare? It was a nightmare fundamentally because I didn't know what I was doing and I didn't get any help. This is apparently my MO. I no longer do that, thankfully. But back in the day with the restaurants and apartments, I was like, oh, I can figure this stuff out. And I did, but my gosh, why go through all the pain and suffering when it's easily avoidable, right? So it's like, it's someone who's stupid makes the same mistake like multiple times. Someone who's smart doesn't, but someone who's wise learns from other people's experience. I was smart, but I was not very wise. And so I got into this thing. First of all, I should have never bought in Washington, D.C. because it's a pro-tenants district. an advisor would have told me, Michael, you probably shouldn't be buying in the district. Okay.
Yeah.
All right. I bought in the district. Then I bought a Section 8 building. Okay. So, and what I didn't realize is that there was a professional tenant in there who was suing the previous owner. And when I bought it, not only were they not paying the rent, they also continued suing me every 2 months for the same damn thing. And so the legal fees and the fines and all that stuff. So in other words, someone should have said, hey, in your rent roll, you may want to, because of Section 8, you might want to do a quick glance at the docket, the legal history. And then I put the wrong property manager in there. The property manager didn't know how to deal with Section 8 tenants, didn't know how to deal with housing authority. And because of that, I struggled with this tenant. This tenant was awful. I mean, I almost ran out of money. I did run out of money in this deal. Like I had to stop my construction project till I finally realized after 12 months, I needed to put a better property manager in place, and they dealt with this tenant in 3 months, and he was out, and things kind of quieted down. But these are all things that would have been easily avoided with a little bit of help from someone who's been around the block.
Yeah. Dude, I think it must be like a Michael thing. Like if your name is Michael, you're probably
Oh
a
yeah,
bit more
you
stubborn
suffer
and
from
think,
the same. Yeah.
yeah,
Is that
we're
right?
cut from a very similar cloth, man. I've got war stories,
Because
and I'm
we're
like,
so smart, Michael. We can do so many things.
we can figure it out. Well, I honestly think it's like a big part of the analytical brain because I'm a professional engineer by training. And so
Yeah,
I'm like, I understand the numbers. I can engineer my way to a conclusion.
absolutely.
And then you
Absolutely.
get there and you're like, oh, wait, it doesn't work like that.
Variables? Unforeseens? What is
Right.
that? That's
Right.
messy. Yeah, yeah.
Man. Okay. So you got it stabilized. And then was that kind of your aha moment of like, oh,
Yes,
apartment buildings, this
very much so.
is the way?
Yeah, this is the way. The only problem is I had like so many people. I had this preconceived notions because I got lucky with it. I kind of got it through a wholesaler. It wasn't part of a strategy, so I wasn't like calling brokers and
Yeah.
you know. I raised money from some of my people I was borrowing money from, but it was a slog because most people were used to 12% note, 6 month turn, and now I'm like, yeah, I'm going to give you a 15% average annual return, but the hole's going to be 5 years. I'm like, nah. I'm not doing that. So raising money for that was a real challenge. I raised like $250,000 at the time, and so
Okay.
I had my doubts about its viability. Right, so
Because you
it
never done it
appealed to me
before.
because I could see what it do. I didn't see how I could do it again and again and again. Right, and
Yeah.
so that was my big holdback. Now, having taught this since 2014, we now know how relatively easy it is to get into the business, and you don't have to have 10 years of real estate investing track record to get in. You don't have to have millions in the bank. A lot of people say, "Oh, I'm going to save my money and then I'm going to buy my first small multi." No, you don't need to do that. You're going to raise the money, right? Or I'm going to use a HELOC. No, you don't need to do it. Just learn how to raise money. All these things can be learned, and teams can be set up, market selected. Learning how to analyze deals within 60 to 90 days, and
Yeah.
you're starting to get live deal flow.
Yeah. And is that what your book talks about?
Yes.
Love it. So give us a preview. Like what's the mentality that someone needs? Because you find all kinds of people from all different walks of life who want to
Yeah.
invest in real estate and who recognize the power of real estate. Should everybody be raising money?
Yes.
Love it. Love it.
Yeah. So you ask, who is this for, right? It's really anyone who wants to scale with real estate. Fundamentally, anyone who wants to become financially free with real estate, which requires scaling. Now, why do some people do flips and some people do rentals, right? They're trying to build another income stream because they think it's a good idea. And then they go, oh, crap, if I do this again and again, I might actually be able to exit my job, financial freedom. And so what happens, though, is when you get into single family house investing of any kind, rentals or flips, you quickly start to have a problem, which is I can't scale this thing, or I can't scale it enough so it becomes a passive income. So anyone who wants to scale really needs to go into apartments, because the only way you can really scale with real estate is with apartments.
Yeah. Yeah. It's funny. Like I ran into that exact issue. I
They
bought my
did.
first house. Yeah. I bought my first house a little over a decade ago. And I was like, oh, I'll do this once a year for 10 years. And in 10 years, I'll have 10 houses. And that sounds
Yeah.
really good. And after my second house, I was like, oh, I need to go buy triplexes, quads, and then commercial after that point. So I totally get it. I totally get it. What do you say to the people that have a lot of experience in the single family space, that like the single family space, that understand the single family space, that are thinking about making that leap, but look at an apartment building that rents for $700 a month versus single families that rent for $2,000 a month, and they're like, I don't know if it's worth. I don't know if it's worth dealing with those types of tenant bases as opposed to what they're used to dealing with.
Well, you don't have to buy in a ghetto. You you can buy an apartment that rents for $1,200, right? Or even more. I mean, depends on if you're in Atlanta or Austin, your rent for an apartment is more like $1,500 to $2,000 a month. So you're not really dealing with a worse tenant profile at all, right?
Okay.
Unless you're buying Class D property, which we don't do. I don't enjoy that too much. The rental profile is no different. It's just simply a matter of scale. Is really what it is.
Okay. All right. And where do you find, as someone who's first taking the leap, making that transition from maybe single family into multifamily, unit count, price point, like where is a good target for people to be thinking about just so they can wrap their heads around it?
Yeah, you know what? It really depends, and I think the biggest shift in thinking around what's possible is your imagination is always limited by your own experience.
Right.
And for me, and maybe like you as well, I kind of had a do-it-yourself attitude, which means that I'm a problem solver, so I'm always asking questions. How do I do this? How do I do that? What I realize now that anyone who has scaled a business of any kind, and specifically in real estate and apartments, people who scale don't ask how questions. They ask who questions. They ask who, not how, right? By the book by Dan Sullivan. And when I read this book 3 years ago, I've known this intuitively for a little while, but this really articulated the major difference in mindset. And when you start asking who questions, almost like the book's 10X, right? The 10X book, when you start asking, how do I 10X something? You have to throw out everything you think you know,
Yeah.
because everything you think
Yeah.
you know is not going to get you to 10X. So
Right.
it,
It's
it
gotten you to where
forces
you
you
are.
it forces you to think at a different level. So when you ask, well, what size? It really depends on what mindset you're. If you're coming from a single family house investing mindset, you're like, you know what? I'm going to go big. I'm going to buy a duplex, which is a house with two doors. Okay, that's not. I mean, yes, that will get you along the path, but really, if you have this who not how mentality, for example, you will start not ask question how can I raise money? But we should learn how to raise money. But the question is who can help me raise money? Now, if you can imagine, let's say you're out there and you're beating the pavement, okay, and you're talking to brokers, you're getting deal flow. You're like, my gosh, I'm coming across these fantastic $4 million deals. There's no way I can raise $1 million. Now, if I bust my ass, maybe I can raise $100,000. Now, would you be surprised to learn that there are people who want to get into multifamily, but they have an affinity to raising capital? Just the way their personality is, the kind of networks they're in, for example. And their biggest problem is deal flow. They don't really love numbers that much. They don't really love the idea of talking to brokers, negotiating deals, and doing due diligence. So in our world, we put them together. It's a joint venture. In fact, almost 100% of our students joint venture in this regard is because there's only two roles. There's a deal finder and a capital raiser. So in that particular world, these capital raisers are routinely have access to 500,000 to start with. Their first deal, they haven't raised any money yet. They're like, oh, I can raise $1 million, and they end up falling short, and they'll raise $500,000, right? So very quickly, within one or two deals, these people have access to major capital, but they don't have access to their own deal flow. So
Yeah.
if you look at it that way, you're like, well, what can I do? Can I do? Well, imagine you meet someone who's got $1 million that they have access to, and you got to go out and find a $4 million deal right now. Now the whole world has shifted. So it's really having this who not how mentality that kind of opens up the world. And this is really how you scale. You're not buying a little duplex. I mean, yes, you're welcome to, but if you learn the art of syndication, get in the right networks, it unlocks something that you never knew was there before.
Yeah. No, I dig it. I dig it. If somebody is coming to your guys' program and says, you know what, Michael, I want to go big. I want to go 100 units, my first deal. What do you say to someone like that?
I do like the fact that they're thinking big. I think I'm also a realist at the end of the day. Someone doing a first deal in a 100 unit, they may play a small immaterial role in a larger deal. So in other words, you can become a capital raiser, and raise $250,000 for a large operator, for which you get 2% GP. So now you can say you're a GP, but you're not really playing a big role. So can you be part of a 100+ unit deal as your first one? Yes, of course. But you're not going to play a material role in that deal, right? So
Yeah.
so again, if you're a deal finder, you're going to find a deal that's a material role. You're probably going to close it, do due diligence for it, and then likely manage it with your partner. Okay, so that's a material role. And then likewise, if you're a capital raiser, so it really depends on where you both are. Like I said, typically, our average student does the first deal size around the $4 million mark, right? Which, depending on where you are, it's not quite 100 units. It might be somewhere like 50 or 60 units, something like that. So it's still a pretty big deal.
Yeah.
Still pretty big deal depending on where it's done. But yeah, so
So you help people get their teeth cut, go learn the ropes on a
yeah.
participatory role as opposed to running it, and then they can go off and do it on their own.
Well, no, they do run it off. If they're a deal finder, they will run it on their own. Yeah, yeah.
Oh,
We
okay.
don't help them run the deal. I mean, we can with their support, but they are responsible for their own deal. We don't take any equity in their deal.
Okay.
So it's their deal. What I'm saying is there you can have a small role in a very, very large deal. That's one way to get into the game.
I dig it. I dig it. Let's talk about due diligence. What changes on going big commercial as opposed to folks who might be familiar with single family?
Yeah, a few things. I think it's just again, it's the same thing. Like I said, same thing but different. You still have a property inspection, for example, and
Mm-hmm.
you can hire a property inspection company. But a lot of times, the property management company that's going to manage your property will do it for you, and/or the general contractor you're going to bring on, for example, or they'll do it to get your business. So, hey, I got a value add deal. I'm going to have to spend $500,000 on this thing. Why don't you help me walk the property? So, yeah, you can, and then they'll typically do that for free. You can also hire certain people to do things for you. It's really very, very similar. You really, when you're doing due diligence, there's a lot more work that you have to do. You have to do rent rolls, for example. You look into financials. So that, when you're doing a single family house, that's much simpler. Their financials are pretty simple,
Right.
taxes, insurance, whatever, mortgage, that's, whatever, some repairs. And so you do have to peruse the financials a little bit more when you get into due diligence. So it's a little more involved, but here's the thing, not much more. That's the thing. It's not like 10 times more involved.
Right.
It's like, I don't know, double,
Yeah.
honestly.
Yeah. I often tell people that myself. They're like, okay, well, if I buy single family, does that mean buying a duplex is twice as hard? It's like, no, it's about the
Well, right.
same. And
Case in point, it should be twice as hard, but it's not. It's
but it's not.
basically about the same.
Right. Right. Okay. What have you been seeing in the insurance space? Because that's where the world I come from, and it's killing people. It's killing deal, not killing people. It's killing deals for sure. What have you been seeing in the big multifamily space?
Yeah, I mean, obviously insurance has been going up a lot, right? Where we're getting insurance renewals, and they're typically we were expecting per year 20% increases in insurance. And the thing is, when you put that in your underwriting and the deal still works, you're good, right? The problem is when something unforeseen happens, right? So in the olden days, insurance would go up by, I don't know, 3% a year or
3%. Yeah.
whatever, right? So you put 3% in your increases, and you're like, oh, that's cool. All of a sudden, insurance starts going up, and it now becomes a real problem because you couldn't forecast it. Same thing with the interest rates going up. Yes, we forecast higher interest rates, but no one could foretell 11 straight interest rate hikes. So once you're in a deal, right, you're kind of set. Right? You bought the deal in a certain way, you made certain assumptions, you're kind of set. And so
Yeah.
when something like that happens, it does create problems. When you're buying one, though, and you're already buying in a high interest rate environment, you're modeling high interest rates, right? If you're in a high insurance premium insurance increase environment, you're going to model a high there. If you're, so you just model in the deal, and if the deal works, great. If insurance keeps going up at 20%, great. That's what you modeled, right?
Yeah.
And so it's really not a problem when you're buying something and things stay. You can really win in three ways. One is it stays the same or it gets better. Right? You only lose when it gets worse. So you have 2 out of 3 chances of winning,
Yeah.
which is not bad. Yes, it's not bad. But
Yeah.
insurance, has definitely been an issue along with interest rates for sure.
Yeah. And how, along similar lines, how do you think about interest rates going forward? Because the debt that you're getting for multifamily, actually, for our listeners who might not be familiar, can you speak to us a little bit about how that differs from what you would get on like a 30-year fixed for a single family? What kind of debt do you like to use on your deals?
Well, so yeah, it depends. I mean, so it depends. Right now, everyone likes to use fixed rate debt, right? Because we got our butts kicked a little bit by using variable rate bridge loans. But there are problems with fixed rate debt, and this is the thing that people don't really understand. Fixed rate debt means that if you have a 5-year hold and you get a 10-year loan, and you're trying to sell in year 5, you're going to have enormous prepayment penalties. Now we can mitigate that by building that into the underwriting. So we have this gigantic exit fee at the end that we have to pay the lender, and so to get around that. But the main advantage of these bridge loans, even though they have variable rates in there, after 12 months you could sell for a point, And so this why did you use bridge debt? That's bad. No, it's not bad per se. Developers have used bridge debt for decades, right? If you're doing
Right.
a value add deal, you're buying distressed asset, you have no choice but to get a bridge loan.
Yeah.
You're not gonna get
Lender's
a
not going to
Fannie or Freddie
finance
Mac.
it.
You're not going to be able to finance it, right? So
Yeah.
it's a bit of ignorance to say, oh, bridge loan bad. Bridge loan is not bad. Typically, it's worked for decades, except for the one time when interest rates go up 11 times in a row. So, but now everybody's like, well, okay, we're not going to do that for a little while. I'm sure it'll come back again when people forget the slashing that we
The
got. They'll
sting.
go, oh,
Yeah.
I really barely remember that. Let's go back to the good old days and lever up.
Right.
So yeah, so we're getting fixed rate debts, and then these are typically 7 to 10 year terms. Again, with some prepayment penalties if you try to sell or refinance. Some of them are assumable. That would be one way to get around them. But who the heck wants to assume a 6.5% interest rate when it's hopefully down?
Right.
Yeah, and then the one main difference is that this debt is non-recourse. Unlike for single family house that you're getting debt on that. It's typically personally guaranteed, as is franchise leases, for example.
Interesting. Okay. So, in thinking about just debt and how it's structured, are you getting 25-year amortizations, 30-year amortizations, something longer, something different?
Yeah, that's right. Yeah, 20, 25, 30.
Okay.
Interest
And
rates are still about in the mid fives. So loan to value is coming up. This is also an interesting trend. So back, a year ago, lenders really backpedal on their loan to value, right? Back 2 years ago, we were getting 80% loan to cost, meaning that it's 80% of the purchase price and then 80% of construction and closing costs. Like, that's nice.
yeah.
Maybe a bit too nice. Then lenders said, oh, that was a bad idea. You know what? We're going to go to 65% of purchase price only. That was, that's how the lenders reacted to the high degree of uncertainty and perceived and real risk. And so now that's starting to thaw again, as not so much interest rates decline, but interest rates have stabilized. That's a big thing. Lenders are always about risk and risk management. And because of the stabilized environment, they're like, oh, yeah, I'm going to lend a little bit more. Still only on a purchase price, but now we're up to maybe low 70s, maybe 75% already. So it's already starting to thaw back up a little bit.
Okay. And you mentioned interest rates, and we're recording this December of 2024, are in the mid fives. So that's going to be a lot lower than what residential, even homeowners are getting. So I think a lot of people are under this assumption that, in the commercial world, interest rates are more expensive than in the residential space. Talk to us a little bit about
And
that.
that is because multifamily specifically has always been assessed at a lower risk by lenders, which is why you're getting non-recourse loans, meaning you don't have to personally guarantee them. That's why your interest rates are lower, yada, yada, yada. Because, the risk in a 100-unit building is far lower than a single family house.
Interesting. And talk to us a little bit about that, because I think for a lot of people that's going to be counterintuitive. Why is the risk so much lower? And for according to the government, like they've done studies on this.
Yeah. Well, look, I mean, if your tenant moves out, 100% of your income goes to zero. Versus if one tenant out of my 100-unit moves out, I barely feel it. Like my break-even rate is, depending on how I buy it, is going to be at 65. That's 65 people. So 35 would have to move out, and no one's moving in before things get really, really bad. But normally the market vacancy is around 90, right? So the probability of you getting to 65, it will only happen if there's a comet hits the earth or something, or your operations are very, very bad. But normally, if you have put a professional, the other difference is in a single family house, you're either self-managing or you have an amateur or semi-professional property manager, typically a real estate agent, managing the property for you. And you're going to get very, very mixed results. And in the commercial world, you actually have a company that all they do is manage buildings. So you have a company that actually manages your building with much better results than if you could do it yourself.
Yeah. And kind of to that point, let's dig in a little bit deeper there, because we started the show by talking about the idea to get to passive income. So now in thinking about, okay, I'm gonna put a deal together, I'm gonna buy the deal, do the due diligence, help raise the capital, or bring somebody on to raise the capital. Now I own the thing. Now I put a professional manager in place. Now what? Am I sitting back on a beach in Tahiti sipping Mai Tais, or is there ongoing hands-on management that I've got to do of this property?
Yeah. A little bit, a little bit. I mean, so what happens when you do the transaction, just like when you're buying a house, okay, it's very exciting, very stressful to get the thing done. You put a property manager in place, and now you're visiting the property more frequently. You're stabilizing the whole thing. It might take you 90 days, and then you, in fact, you have a single call with your property manager once a week, and you review the numbers, make some tweaks and adjustments, but you really just let them do their thing. And so, yes, you take a little rest for a minute, but then most people simply going to go, oh, I'm just going to do it again. And so, you can do the same thing with single family house rentals. Same thing. The only problem there is you're only adding one unit every time you do a transaction. So when you do a multifamily, you're adding multiple units. And typically the deals get bigger as your credibility goes up, your ability to raise capital goes up, your network expands. If you start with a 20 unit, you're going to do a 50 unit. If you're doing a 50 unit, you're doing a 75 unit. Each time you do a transaction, the numbers get bigger, right? And so you can layer one over another over another. And the thing that most people don't know about this is, yes, there's passive income, but that's not the interesting thing about it. And there's profit. The thing that's really interesting is the acquisition fees. This is material because you don't have that in either rentals or flips, right? Because with rentals, you won't get paid in forever. Right, you paid like when you finally sell the daggone thing 10 years later. With a flip, you get paid in hopefully 6 months, and you don't get any cash flow. But with multifamily, you get this giant acquisition fee when you close. You then get cash flow while you hold it, and then you get a giant pop at the end. It checks off all three boxes. And these acquisition fees are substantial. They're 3% of the purchase price. So going back to this $4 million deal that we talked about earlier, someone finds a $4 million deal, partners with a guy that has access to $1 million of capital. $4 million deal, it's a $120,000 acquisition fee that's split between the two of them. Well, let's say your expenses are $10,000 a month. Now you each got a 6-month runway. Maybe you got another $60,000 in savings. Like, I have a year runway to do a second deal. And most people, by the time they close that $4 million deal, already have a second under contract or in the pipeline. This is why so many people are able to quit their job after just their first deal, because the acquisition fee and then the pipeline that they see coming out at the end of it.
Yeah. Interesting. Very interesting. And Michael, what are you seeing? What are you hearing in the multifamily development space? Because I think a lot of our listeners, and I know myself, we constantly hear about, okay, new starts, or there's a ton of inventory coming online because they underbuilt from '08, and now that all that inventory is coming back online with a big supply slug. How do you think about that?
Yeah, no, it's a real thing, and it actually affects some properties in some markets. So what happened is there was a lot of free and loose money after COVID, right? So a lot of these permits were pulled in 22, and construction started in 22, 21, 22, 23, and they started to come online earlier this year through about the middle of next year. And so depending on where the property is, especially if it's more of a Class B property. And these Class A's, there's so many coming on market, they're just competing against each other. It costs about the same to live in a Class A than a Class B. So the Class B gets affected a little bit, right? Mm-hmm. So these new Class A things actually do affect existing housing stock. And as a result, rents have gone down a little bit, or they've at least stayed stable after having run up 25% in 22. And so that has been putting downward pressure on rents in certain markets, especially some of the larger metros that have a lot of these housing starts. But here's the thing to say about that. If you look at the permits that were been pulled over the last 12 months, the volume is down by like 81%. It's like, and it's going down because developers, since the run up in interest rates, can't make money developing anything. So no one's pulling permits. They're all sitting on raw land right now. They're literally, it's almost come to a screeching halt. So once these things get finished, probably through the middle and maybe end of 25. Most of them are going to done in the earlier part of 25. There's nothing behind it at all. So I think 25 is going to be kind of a market of small, slight growth. This 2024 has been a little bit of a market of stability versus last year, which was completely chaotic. Yeah. And so we're going to have mild growth in 25, but I think 26, unless there's a catastrophic event, simply by looking at the supply and demand, the forecasts, the rents could go up higher than the normal 3%.
Yeah, I know it's so interesting, like to watch the cycles to see how the interest rate impact is showing itself up and throughout all these different aspects of the market. It's pretty wild. Man, well, Michael, this was a ton of fun, man. Thank you so much for taking the time. If people want to reach out to you, learn more about multifamily investing, get your book, listen to your podcast, what are the names of all those and where can they find you?
Yeah, the book is called Financial Freedom with Real Estate Investing, and that's also the name of the podcast. So, Financial Freedom with Real Estate Investing, you'll find it on Amazon as well as on iTunes or Spotify. But if your listeners want to learn more about going from single family houses to apartments, I have a free course they can watch. It's called Apartments 101 Creatively. Apartments 101, and it's at apartments101.co. So, apartments101.co, and they can just sign up, and it's about 45 minutes long.
Sweet. That's awesome. And if folks want to reach out to you directly, is there anywhere, where's the best place for them to do so?
Yeah, so I'm on Instagram. The handle is the Michael Blanc. So I'm on Instagram, LinkedIn. Website is also themichaelblanc.com. So different ways you can reach me.
Sweet, man. Well, hey, thanks again, Michael. This was a ton of fun, really informative, and I'm sure we'll chat again soon.
Thanks so much, Michael. Appreciate it.
You got it. Take care. All right, everyone, that was our show. A big thank you to Michael for coming on and sharing some really great insight, wisdom, and knowledge with us. Definitely worth checking out his podcast and website if you are thinking about investing in some bigger deals and looking to raise money. As always, we love hearing from you. Ratings and reviews are helpful for us to reach a bigger audience, and we love hearing from you about what it is you want to hear more of. As always, we'll see you on the next one. Happy investing.